Everybody, Brian Shannon here from alphatrends.net. Today is Friday, the 22nd of April, 2016. Hope you had a good week in the markets. The Nasdaq did lose some ground this week, mainly because of today, and we'll talk about some of the reasons for that. We also lost ground in the semiconductors, which are obviously part of the Nasdaq, or have a big weight on it, rather. And biotechs got back some another 3%, still down 15% year to date. But overall, you got to be kind of impressed with the market. Bonds did lose a little bit of ground, and we'll talk about those as well. But let's take a look at the action on the charts. The S&P 500, again, we're up again this week. We continue to make higher highs and higher lows on this daily chart. And right now, as I've been pointing out, we've seen that these little pullbacks have done nothing more than to strengthen the resolve of the buyers. That is, they suck shorts in and then continue to move higher. Now, we've been discussing this trend line, and this trend line here had been touched this week. And you could argue, I guess, if you wanted to be argumentative, that it was resistance. We didn't close above it. So for the short term, I guess those people who like to argue can say that is resistance. But the fact is, we have a short-term level where we pulled back. Now, we are below 5-day moving average. The 5-day moving average is advancing, so that tells us it's just another time to be cautious, just as the last few times. Until we have a pattern of lower highs and lower lows below a declining 5-day moving average, this tells us just to be cautious because we're in an overall uptrend, and we're not going to look to get bearish just because we break below that level, but to look to see where the buyers and sellers maintain or regain control. That is, the buyers, we consider this market still innocent till proven guilty. Now, for the week, we see that the volume weighted average price was right up near that 5-day moving average, which makes sense, but because the week is 5 days long. But next week we're going to look at this level as, until we can get back above this level here, we're going to be cautious. Once we're back above that level and can hold above it, then we're going to be looking at this market again as the buyers are back in control. We saw a number of earnings reports this week, and that just picks up even further next week with some big names reporting. And of course, it's always stock specific as far as how the stocks respond. This week we had pretty negative response, in particular in the Nasdaq stocks. But let's take a look at the SPY. What we want to see hold next week is really 207-ish. If we can hold above that, then we're still intermediate term, pretty neutral overall, and it's more likely to be a correction through time than a deeper price correction. The Nasdaq, let's take a look there. You can see this is our first close below the advancing 20-day moving average. So in the past, during this rally, we've seen the market come down to the 20-day moving average on numerous occasions and close above it. This is the first close below that level. We also closed, when we look at the intraday chart, below this prior level of support. So we broke support that we had seen this week, and we do have a lower high and lower low below a declining 5-day moving average. So that tells us we have to be cautious in regards to the Nasdaq. Perhaps we're going to continue down towards this 50-day moving average and our next bigger potential band of support down here. So I think that you just want to be very cautious in regards to the Nasdaq. If we see that the market recovers, and that's certainly a possibility, then it's going to need to get back above and hold above 110.25 for the intermediate term trend to be considered okay once again. But until then, I would consider these rallies as, looking for any rally that we see up towards that 5-day moving average. I would say that you want to be short-term trades until we can get back above and show some more stability. A lot of times what we see in an emerging trend that we've seen, from the February lows, is that early on, it's the 10-day moving average that acts as support. As the trend becomes a little bit more mature, it's the 20, and then as the pullbacks get a little bit deeper, then it's often the 50-day moving average, and that's certainly a possibility. And speaking of that, Apple, this is something that I've been telling subscribers this week. It looks like Apple is headed towards its 50-day moving average. We had spoken about getting out of Apple if it broke below this level in particular and stayed below it, and it's done that. So there's no real reason that I can see to own the stock right now from an intermediate term basis. This company does report earnings next week. It'll be interesting to see how it responds to that. Here's our year-to-date volume-weighted average price for Apple. So we're still clearly above that, and perhaps we get a little shakeout below the 50-day moving average, and then can start to show some stability. Buying blindly into a 50-day moving average usually isn't the best reason to buy a stock. What we look for instead is we look at that 50-day moving average and say, why is that an important level? It's an important level because a lot of market participants assign importance to that level. So for instance, if we have short sellers who are short this stock, let's say from 110, 109, even 108, they might look at the chart and say, hey, you know what? My target is that 50-day moving average, so I'm going to buy some back there. By them buying back stock and not adding further shorts, we remove supply and we add that potential for demand. And then so the shorts might cover in there. Also, we can see that longs who might have been involved down under $100 a share decided, hey, we're going to take some profits off before earnings come out. We'll take some profits off before the earnings, but once it gets down to that 50-day moving average, that 50-day moving average often acts as support. So we're going to stop taking profits down there. And in fact, let's see if we stop taking profits, then that excludes that source of supply from the market. They might even begin to purchase some shares back lower from where they sold up near, let's say, 110, 110, 109. And then, of course, there's always sidelines cash that says, hey, it's at the 50-day moving average. That's what I've been waiting for. I'm going to start to put bids in. So we see that the 50-day moving average often is a level of support, and largely because it tends to be a self-fulfilling level. We don't want to buy there, though, until we have the actual evidence that the buyers are in control there. So when we see that it's down, under 105, that 103 and a half ish, that if we get down to 103 and a half, if you want to just blindly put bids in, that's fine. I prefer not to buy on pullbacks, but to wait until a pullback has resolved itself and then the buyers reemerge and gain control. Anyways, just a quick lesson on the 50-day moving average is what you got there. The Russell 2000 showed much greater strength today, and I was asked, well, what does that mean? Well, it means that people are buying small cap stocks rather than the larger stocks, and you don't have to read into it. It means if you want to be long an index, the IWM is the better index to be long, not the Nasdaq 100. So each trade based on its own merits. You don't trade the Russell 2000 based on what the Nasdaq is doing. You trade the Russell 2000 based on what the Russell 2000 is doing, and it closed right at the highs for the week. And as we saw, it did show a gain here this week, and a gain of 1.4%, which brings it positive year to date. And that's something that hasn't happened in a while. That we've been closed, on a positive basis this year. So, where are we in regards to prior levels? Maybe 115 is resistance. It's definitely a possibility, but the fact is it's better to just manage risk in an uptrend and stay with that trend rather than trying to pick the tops. So we saw in the Russell 2000 the same thing we've seen in these other markets, which is we get a little shakeout below that advancing 5-day moving average, and then it continues to move higher. So for next week, we're going to want to see that about 112.5 is the first important level to hold. If it breaks below that, then we get a little bit more defensive in terms of the Russell 2000. So back to the Nasdaq. Be suspicious of rally attempts is the main point there. Now the semiconductors, I've been saying that this chart's a mess here, and it's basically in a void. We have right now the 10 and 20-day moving average crossing, which shows a sign of indecision. Moving average crossovers represent indecision, and we see that occurs kind of in the midpoint of what's been this range. Now the 50-day moving average is rallying up, and we've seen a nice rally in the semiconductors this year. So a little bit of a pause in here is certainly not a bad thing. And I think that what I think is likely to happen here is that if we get a move below this level and perhaps test that 50-day moving average, I think it's likely to come back up and then squeeze the short sellers, because the primary trend is still higher in the semiconductors. Biotechs continued to show some strength this week, as we noted. And on the larger picture, we've been talking about this level here of them getting up towards that $300 level. And I still think that's a definite possibility here. It looked like we had the potential to break down, and I was certainly cautious in here as it had broken below that 5-day moving average, but it did not make a pattern of lower highs and lower lows. So on Thursday, we went back to a positive bias on the biotechs as they broke back above that 5-day moving average. And now I think your key level of support next week will continue to be down here near about 278. We had broken a little bit more of resistance in here, and if you wanted to keep tighter stops, maybe just below here at about 283. But they do look like they're still heading for approximately that $300 level. Last week I had mentioned PayPal as a candidate for a short squeeze. We've still got a large short position in there, and the stock has moved higher here. It's a little bit choppy, and as for subscribers, we currently have a stop just under today's low after that shakeout on the open and retest of it. But the trend is still higher in PayPal, and it seems like it should be able to continue to move higher. What you got to be aware of, what you have to be aware of, is the earnings reports. And looking at stocks such as Google. Google's had quite a volatile year, and this is the volume weight. This purple is the volume weighted average price year to date, and you can see we closed below that. What that means is the average price that this stock has traded at, adjusted for volume, so the dollar weighted price average is about 400 and what was that? It's about $743 a share. So the average participant this year is down in Google, and it's a big mess, really. It's just kind of going back and forth. We also saw, Netflix lost ground and broke below and held below its year-to-date volume-weighted average price. Netflix, I would say, stay away from it. Let it settle down. There's no hurry to own these stocks just because they're brand names like Microsoft. And in fact, this week we traded Microsoft in Alpha Trends right from here to, I don't remember where we got stopped out, right around in this area though, and avoided this big mess. And even with brand name stocks, be aware if you're buying stocks in front of earnings, you're taking a big risk, like Starbucks, a big brand name. Anyways, the financials, these guys are as we stated, the financials had a good week, up to close to 3% this week. So financials are still, they were looking cautious over here coming into earnings 2 weeks ago. As I mentioned, I thought it had the possibility of doing what I was talking about with these other markets in Apple, which is to come down and maybe pierce below that 50-day moving average. It didn't do it, but to quickly recover. And from failed moves often come fast moves higher. So in other words, if Apple breaks down below that 50-day moving average and then recovers, you could see a quick move back higher in that stock. Now, the TLT, I don't talk a lot about bonds, but they're still clearly in a longer-term uptrend. We've got a rising 20, 30, 40-week moving average. This week, we saw them lose some ground, and they came right down to the year-to-date volume-weighted average price. Now, we're below a 50-day moving average, so I would say be very cautious in here, but this has been an important level, and I think they're likely to maybe settle down in this area before they're likely to make any large move next week. But again, be aware, be careful about earnings, and that'll do it for me. So have a good weekend. Thank you.